Good morning. It is Friday morning, and it is uh, the real estate live chat. So here we go. Let's get started. We'll go ahead, post your questions in the chat as you have them. That'll be fun. And then, let me go ahead and get started. Let me recap everyone on the week that we have had. I've got a bunch of questions that we can go over in lieu of people asking questions on here. Uh, I've missed the past couple of live streams for a variety of reasons, but we are back and we are going to go over a lot of stuff. So we have a big day today. We're closing on about 6 properties, and we did the same last week. So last week was a big week as well, where we bought 6 stores. And I mentioned a while back that we were kind of pivoting our strategy, kind of in preparation for the winter, as you know, some move-ins kind of slow down a little bit during those times. So we pivoted. We also have a large amount of open rehab projects on our table. So we decided that we were going to slow down. We were only going to purchase properties that were already rented, properties that are rent ready, or properties that are the lightest of turns. So that's cool. We have started doing that. So this past Friday, all of the properties fit that description. Most of them were already rented and or rent ready. There was one property that is kind of a medium rehab that we purchased, but it takes a while to go from buying properties that need rehab, just the cycle of putting properties under contract, the prospecting, the putting them under contract, and then kind of moving that strategy around or implementing that strategy. So now all of the properties that we're buying today are all either rented or in rent ready condition. So that's been a fun strategy. It allows us to get a lot of properties on the market very quickly, which is pretty cool because, there's barely any holding costs. We'll get them all rented out pretty soon. And we're actually to the point now where we need to start putting some more properties that need rehab under contract. So it's pretty crazy how quickly that has happened. And the only reason I say that is we've got a couple of contracting crews that we really prefer to keep busy. These guys are nice enough to kind of prioritize doing their business with us. So we like to always kind of keep properties in the hopper for them. And as we pivoted, kind of changed our strategy, we are running out of some of the larger rehabs that people really like taking on. So it's all a balancing act that's really difficult to kind of stay perfectly balanced on, but it's one that we are having a ton of fun in trying to figure out. So we've made a couple of different internal changes, which I'm really proud about. We've hired one more individual on the property management side, and one of his main focuses is going to be improving kind of the resident relationship or the resident experience, which is exciting. So, in striving to do this very well and truly provide people with, great service, a great experience, there are a lot of different areas of our business where you could explain it away based on like our history and how we've grown over the past couple of years. But we really lack in some areas, and communication is probably the main one. So we heavily lean on technology, automation. Like we don't have a phone number that you can call and get a hold of anyone. We are responsive to voicemails, text messages, and the work orders. So we monitor those things very quickly, but we'll reach out in return in either email or text message fashion, which works for the most part. But there are some issues that come up where it's better to be able to call someone, and we just historically haven't been in a position to offer that. So we're working on it, and hopefully we'll have that resolution in place. But we're going to start going over a book called Fans First by a guy named Jesse Cole, kind of as an organization. And as you could imagine, Fans First is the entire premise of the book. But we really want to kind of create a really unique feel in this industry that even though we are building, a pretty good sized portfolio, we still want to connect with the residents, provide a really awesome experience, and always be able to fix issues promptly as they arise. So we're going to work on it. We're going to collectively build that up as a team, and I'm looking forward to telling you guys about the new things that we implement. We currently have 17 properties under contract. We're closing on 6 of those today. So we're getting a lot of really good deals at the moment. We have multiple properties under contract, under $50,000 at the moment, which it's been a while since we've had properties under contract for lesser than that. A couple of them are even under 40,000. So good things are happening there, and all of them are under 80,000. So, and looking at my estimated after repair values on all of these, they're all over 90,000. So that's solid. It's in a good spot. Let me go through. One of the questions that I get asked a lot is where we find these deals. There's a squirrel outside my window that is stretching up the screen. All right. So just really quickly, I'm going to go through and figure out which ones were on market deals and which ones were off market. So of the 17, so of the 17, 14 of those are from the MLS. So keep that in mind. As I mentioned, that all the properties that we have under contract at the moment, the majority of them are under 50,000. All of them are under 80, and 14 of them are off the MLS. Now, I would say on average, these properties that we have under contract that we found from the MLS are under contract for about $20,000 to $30,000 lesser than what they're listed for. So there are good deals to be had on the MLS. And I would say that normally we're about 50% off market deals, 50% MLS deals. I would say that probably the reason that we're heavy on the MLS right now is because we are implementing that strategy of purchasing properties that are either already occupied or rent ready. So I imagine once we start taking rehab projects on again, we will increase the number of off-market properties that we get to. The 3 off-market came from just relationships. So these are people that were aware that we buy homes, and they came across some people that wanted to sell properties and recommended us that way. All right. So I did a YouTube short a while back, and it's picking up some traction, and it's starting to get a decent amount of comments. And I was just going through how I bought 2 properties with seller financing. And one of the questions that I got was, how does the seller make profit if the buyer is only paying the mortgage in a seller financing transaction? So I think so there's 2 questions regarding that. How does the seller get paid if the buyer is only paying the mortgage alone? So the seller is likely not going to sell the property on a monthly basis or on a seller financed basis just to pay the mortgage. So the mortgage of the seller is going to be lower than the new mortgage of the buyer. So if you're going to seller finance a property and you have a mortgage on the property, if your mortgage is $300 per month and you sell it to somebody else via seller financing, probably on a land contract, if there's already an underlying mortgage in place, then your minimum payment of that land contract will likely be, I don't know, there's going to be a spread between that new land contract payment and also the underlying mortgage. So if that initial original underlying mortgage is about $300 per month, then I would think that the seller financing the land contract payment would be $450, $500, $600. So the seller would be making the spread between the land contract payment and his initial mortgage payment, or that original $300 per month amount. So I would say that's probably the main way. And then I would say the other way would be in the event that there is no spread, in the event that the land contract payment is that $300 per month and the seller isn't making any money on the actual monthly payment, then I would guess that he sold it for a higher price and the payout would come later. So if the original mortgage is for $40,000 and the payment is $300 per month, if you sell it for $80,000 but agree to a monthly payment of $300 but a 2-year balloon, then at the end of that 2-year mark, when the balloon payment is paid, then you would make that $40,000 difference. And there are a couple of reasons that I could see that scenario being a viable strategy for both the buyer and the seller. So that's an example of how the seller would make money in the event that they have an underlying mortgage and also want to sell the property on the land contract. And I think one of the things that is important to remember when it comes to seller financing is, the only reason that a lot of lenders, when they get really big, it's easier for them to process things in kind of cookie cutter format. But if it is just you and the owner of the property, then there is no cookie cutter format. Any terms that you two agree to that are mutually beneficial, you guys can execute and see through. So it's a really awesome tool as far as negotiation goes. Here's an easy question from David Duncan. Love all your videos. Are you still doing life insurance? No, I am not. So life insurance kind of taught me a lot. And life insurance is kind of like flipping a house. You get paid significantly more than you would on a rental property, but you only get paid one time. Whereas on a rental property, you get the cash flow, you get the appreciation, the principal pay down, and the tax benefits. So in life insurance, I learned that I am not comfortable with the stress of one-time payments. So I never appreciated getting paid once and then never again for my actions. So I remember when I was selling life insurance, there was a month where I made $20,000, which was huge for me because this was less than a year of after I left law enforcement. However, I still had trouble sleeping because even though I had just made $20,000, I had no idea where my next paycheck was going to come from, because I would have to find new people. I would have to, sell new people, and I would have to build deep relationships very quickly to gain the trust and then just move on from selling the life insurance policy, because it's one where most life insurance companies, the way that the compensation is structured, is you get paid once and then never again. So any of the service that comes afterwards, there's no real reason from a business perspective to maintain that relationship on these kind of one-time deals. And I just didn't like that. I didn't like the payment structure. I didn't like not having a real need to build lasting relationships, just kind of making good impressions, building the trust, and then doing that. So when I was having those sleepless nights after from all other metrics, a very successful month, I made a vow to myself that I was never going to do anything again that only paid me once. So I started focusing on things that had residual income. So if there's no residual income attached to it, you likely will not find me doing it. So while I have violated that vow a couple of times in like selling properties, or I've accidentally wholesaled properties a couple of times, And I would say there are exceptions to the rule. Vow at this point is probably a strong word to it, but I definitely have kind of adopted it as one of my guiding principles. So the kind of low and slow, building a machine, building residual income, and not getting distracted by things that have large dollar amounts or paydays attached to them in kind of lump sum payments. So there's a couple of reasons that I do that, but for the most part, that's where I'm at now. So not in life insurance anymore, still on the property and casualty side. Now, the property and casualty side, similar to rental properties, there is significantly less commission to be made on the property and casualty side. However, you get paid the same amount of commission year over year, so long as you keep your clients happy. Another good question that we got from Lexi Rosebud is, why do you charge yourself a property management fee? I think that's a really good question. We did that from the beginning of us taking over management. So on paper, it's probably always prudent for you to do that. Charge yourself a property management fee, even if it's your first property. And you should likely, inside of that fee, you should allocate those funds to paying you for what you're doing on behalf of managing that property. So if it's industry standard for there to be like a $45 minimum service call, then whenever you have to do anything for your rental property, from that management fee, you should pay yourself $45 or whatever, rate you should. So if you are full throttle, really strapped for cash, then I suppose it would be wise to forego this for a while. However, you are building a business, and the business is going to need to pay someone for something. So if it is you, then you should pay yourself, even if it's just like a formality and you're going to put those funds back into the business. You should just get into the habit of doing that. I think it's good practice. Now, when we first started, we used a management company, and we paid the management fee. We did not retain like a second management fee on top of that for ourselves because we had a property management company. Now, whenever we hit about 60 doors, we decided to take property management in-house, and that is when we started, charging us that management fee. So when we had 60 doors, from day one, as soon as we took management in-house, we were able to retain about $5,000 per month, because that used to be going out in the management fee. And then we kind of started our own property management company. We shouldn't necessarily call it is a property management company, but we only manage the properties that we own. So now, those monies go to paying the employees, and all the other overhead expenses that the property management company incurs, the software payments, the domains, the phone lines, all of that. I think the management fee is really important because you don't want to overlook the fact that you are building a business if you decide to self-manage your properties. And I think a lot of the tired, beat down landlords or real estate investors that we purchase portfolios from have kind of really miscalculated how quote unquote passive this was going to be. So they never built the infrastructure to deal with the headaches that naturally come with running any business, especially one that's like a property management company. So I don't know, even if it's just on paper, you should probably charge yourself that, just to kind of keep the fact that you are building a business, not a quote unquote passive income stream. On paper, I feel like if you look at an account, you slowly build $1,000, $2,000 in that. You're like, what's that account for? Oh yeah, I've built a business. So while it's irrelevant to the question asked, I would say that one thing that I have seen now over the couple of years doing this is a lot of the people that start buying properties based on YouTube channels, podcasts, books they've read, things like that that talk about passive income and real estate investing and, leave your job. Sure, you're going to be able to leave your job from real estate, but it's not like you're going to be able to, go do whatever you want to on a daily basis and not ever think about your actual business. The people that come in with those expectations, I have seen sell their portfolios in the first couple of years. It's really important to build out the appropriate infrastructure to actually manage your investments. And unless you are riding the coattails of some very motivated people, you are never going to have quote unquote passive income where you can just take these assets, give them to someone else to manage, and expect to not have issues and expect for them to flawlessly handle all the aspects of your business. There's a lot of active ownership involved in properly caring for and keeping deferred maintenance at bay on these properties. It's a good question. Good morning. Is it better to have 30 properties valued at 100K or 3 properties valued at $1 million each? What are the pros and cons of each approach? So this really just comes down to personal preference. I don't think there's a right or wrong to this question. I think it really depends on your long-term goals. And, one thing that people are probably tired of hearing me say is there are just as many different ways to make money in real estate investing as there are people investing in real estate. I could come up with scenarios to both of these in my head that make perfectly good sense based on someone's, personal preferences and, where they're at in life. So I would very quickly throw out the myth that, higher valued properties come with residents that are less of a headache. That is not true in the slightest. And I would say you're kind of setting yourself up for failure in believing that. So, there are jerks in all socioeconomic status, whatever the word for that demographic is. So I would dissuade and I would not allow that to be factored in your decision at all. From a financial perspective, I would say that 30 properties at $100,000 each would be a little bit more diversified. You could handle a lot more vacancies before it impacted your business, the same as if you had, 3 properties valued at $1 million each. I would also want to know if we're talking about doors or just actual locations, because if you're talking about 3 single family homes worth $1 million each, I have never built a business around that model, and I wouldn't know, kind of what to expect. So our, business model revolves around our average property value at this point is probably around 100,000. But when we first started, I would say that the average property, the after repair value was probably in the $60,000 range. So the market has appreciated greatly where we are. And, I think the obvious thing here is if we're talking about percentages and, we're calculating the return on investment from a percentage perspective, then I'm sure they're probably comparable. But I would say the biggest differentiation, which is, easy to spot, is, if you have 3 properties worth $1 million each, one of them goes down, then that's 33% of your portfolio pretty quick. That's about all I've got. All right. Eric Young asked a good question. Do you find it matters whether or not you purchase in winter months or warmer months? Is there a time of year that it's more or less advantageous to purchasing, rehabbing, and renting? I watched an interview with Charlie Munger recently, and he said something that I thought was really fun. He said, "Hey, we just keep swimming. Sometimes the tide is with us, and sometimes the tide is against us. But all we do is we just keep swimming." And I thought that was, a good way to put a lot of problems that you have. I think, there are pros and cons to buying in the winter, just as there are buying in the summer. I will say that, the market as a whole, like activity, picks up when it's warmer out. So more people are moving, more people are out looking at properties. However, you could still rehab, you could still, so the construction, that part never stops. Rehabbing in the winter, rehabbing in the summer, it doesn't really matter. Obviously, it's difficult to do exterior stuff in the winter. Oftentimes, exterior stuff is shelved for the warmer months. But, here in the area, people are understanding of that. And we have rented out properties that look pretty bad on the outside while telling people, hey, as soon as the weather turns, these things will be addressed. It's just a matter of getting the snow off the road. The other thing that you kind of have to watch out for is, in the winter, the utilities become significantly more important. Making sure that the furnace is active, working. That keeps everything at the appropriate temperature. It's tough to work when it's below freezing inside of a house. So having proper utilities at properties is a big deal. It kind of becomes exacerbated in the winter months when things can freeze, especially if there's water, things can burst, cause a lot of damage. That's not good. But from a construction, rehabbing perspective, work doesn't stop. People work, um, you know, in the winter as well. So we have noticed a slowdown in the winter months of us being able to get properties rented out, which is why we've pivoted. It's why we have steered towards buying only rent ready or light rehab stuff. However, we have to keep our guys busy, so we'll probably have some number of rehabs all winter. Davo TV says, "How do you find your deals?" All of the ways that we find deals, we try to utilize. So I made one video called "The Seven Streams of Deal Flow," and I think that is really important. If you listen to a bunch of financial gurus and read a bunch of books about personal finances, kind of the thing that you should strive for is having seven streams of income. And I think the same is true for lead generation on any business. I think if you are in business for yourself, if you are interested in building a business, then one of the first things that you need to do is automate seven streams of lead generation for you. Now, I think the same is especially true in real estate investing. So if you are interested in buying properties, either fantastic deals or building a large portfolio, regardless of what it is, you should probably identify seven streams of deal flow. Now, in real estate, since there are so many different avenues of investing in real estate, this could be significantly more than seven if you have time for it to be. But I definitely think that you focusing and you attempting to automate seven different streams of deal flow, you'll get more deals. You'll be able to cherry pick the better deals or the best deals that come your way, and you're going to be able to build a portfolio or even start selling properties to other people really quickly to generate additional income for you to then go out and buy properties. So you know, finding deals is one of the most important things that you can do as a real estate investor. The more proactive you can be, the better off you'll be long term. All right, so another question is, this may not be the video to ask the question, but here it goes. Can a person do what you do and how you do it if they have a federal tax lien? How can you still get financing, rehab, and then refi if you have some cash but a tax lien without paying off the tax lien? So I think this is a really good question. I do. And I think that it is, one thing that is a little bit kind of misleading about our starting place, right? So we bought our first property in 2017. It was a duplex. We paid $35,000 for it. And I did that in all cash. So, you know, I I got my first job right out of college, and I saved 50% of my income from the day that I was hired. So whenever we were starting in 2017, I had like $100,000 because I liquidated all of my retirement accounts on purpose. It was a strategic play on my part, and that's what we started with. So if you want to go back to when I got my first job in like late 2011, early 2012, then that is technically when I started investing, right? Because that is when I was setting myself up from a financial perspective for success. So, what we started doing in the real estate investing world in 2017 wouldn't have been possible if I wasn't already in a solid financial position. Now, I think it's important to note that during those times, the most I made was like 44,000 per year. I was in a pretty low income producing job. So, that's what it is. I was never a high income earner, and I was just very frugal and saved the majority of money that I made, 50% or more. So that is what I would say. I would say, in order to really set yourself up for success, you should try to start or get yourself or build yourself to a position where you are as close to zero as possible. So, there are ways that you could invest, and perhaps it may be prudent for you to invest with this tax lien on your shoulder. However, best case scenario is that you would really focus, double down. You could build your real estate investing skills. You could start finding deals. You can start selling deals to other people, charging 5,000, 10,000 if it's a great deal, $15,000 fees or more, I suppose, and then using that money to start paying off that federal tax lien. And while it would be possible to start investing in real estate with that tax lien on your shoulder by using all cash, by not going to traditional lenders for loans, then I would say you're kind of setting yourself up to have an uphill battle. And part of me thinks that from a progression or exponential growth perspective, you would be better off having the banks on your side and being able to pay that off and start just getting financing. Because, even if you used private lending and you had people that are willing to listen to why you have a federal tax lien and why you're still a safe investment, even considering that tax lien, they're going to be at a higher interest rate. And I think from a long-term play, one of the ways to really tap in and leverage debt in a wise perspective comes from traditional banks being willing to lend on, these these properties because they're safe. You're going to get yourself a low interest rate, and you're going to get yourself a very long amortization period. So, in order to truly be firing on all cylinders, you need to really get this tax lien paid off. Now, I say that, however, I would also say that banks, even if you were starting at zero, you're going to have this 2-year runway where you have to kind of prove yourself as a real estate investor. Have ran some real estate investments successfully for 2 years before the banks are going to start counting your real estate income for you, so that you can qualify more so for traditional lending rather than just based off your personal income. So you're going to have about a 2-year period once you get started where you're probably not going to be all that bankable. And traditional banks, even if you were the perfect candidate, would still be leery on giving you some loans based on the rental properties, not just your personal income. Now, if you're also a high income earner, then you likely won't have this issue as much. So I could see how it would be prudent to kind of form a plan where you're going to address this. You're going to start investing in real estate and also start paying down this tax lien over a 2 year period so that you have a rental property or two that you've used from your cash and you've been able to acquire by going out and negotiating seller financing, building the trust of other people, convincing them that you're a safe risk, even with your federal tax lien, and get a couple of rentals under your belt so that, when you reach that 2 year mark, you've got some real estate rental investing history. And then you also have you've paid off that tax lien. So that's not counting against you as well. So if you can work both of those at the same time, then when you hit that 2 year mark, you're going to be able to start getting refinancing into some traditional loans, pulling out that initial capital that you've invested, replacing any private lending that you have with that low interest rate, long period amortization type funds. But I would say, for the most part, it always pays off to be as above board as you possibly can and dealing with things the right way. And, especially when it comes to traditional lenders, they have a, long, long period of, actuarial data, statistics behind them that lead them to make the decisions that they do. That's why, this credit rating system has, any weight behind it, is because it's, from a statistic standpoint, from a kind of cold, not necessarily caring about the underlying individual that holds that score, but it's a good indicator as how good of an investment someone may be based on their past history. Having that as clean as you possibly can is one of the most important things that you can do to fully leverage and utilize that long-term, low interest rate, long amortization period type financing to best build your wealth. So, everybody makes mistakes. I've really hurt my credit scores in the past, and it's something that you should know exactly what goes into it. Anything that could be a negative thing against you from a financial perspective, you should go above and beyond and work diligently to clear that up as fast as possible, not leave it lingering, so that you could have as few obstacles as necessary in order to really set yourself up for your real estate investing career. Because you're going to be presented with tons of obstacles just as you're naturally investing in real estate. You don't need to unnecessarily add some to yourself, which I think is a really good segue into the truth about real estate investing with no money down. And I think one of the biggest misconceptions of investing in real estate with no money down is that you can truly do it without money, right? So, as you're buying rental properties, as you're buying the real estate, the amount of exposure that you're taking on is always going to be greater than the amount of money that you have on hand, right? So I would say if you look at all of the things that go into a house, it's all perishable materials, right? The weather is always going to run its course on these properties. It's unnatural for a house to be here. So every single day that goes on, the wear and tear is going to be greater. The weather is always going to be, doing damage to your home, and you're really fighting against Mother Nature to keep this thing upright. So I would always plan on replacing a house in its entirety over, a 70 or 80 year period. So as soon as you take on a property, the amount of money that you potentially have to pay to fix things are going to be greater than the amount of money that you put down to buy the property and the amount of money that you likely have on hand, right? So, across our portfolio of, at this point, 360 homes, if everything that could go wrong happened to our portfolio, we wouldn't have enough cash on hand to fix it. We would have to break it down in phases. We would have to use the income coming in from these properties to strategically address a couple at a time, right? And I think if you try and invest in real estate without any of your own capital, like if you have no money, then you're only going to be setting yourself up for success. You're going to be in a race to start building your own capital before things start going wrong with your rental property. The amount of money that is going to be brought in, the income produced by these properties, are not sufficient in and of itself to pay for all of the things that could go wrong with that property. So it's really kind of setting yourself up for failure in my in in my experience, and in my humble opinion. I would say one of the most important things that you can do as you're getting started in investing in real estate, if you have no capital. Now, I think there's a difference that should be, and there's two different types, right? Like, you can invest in real estate without deploying any of your own capital. That's what we do. But that's inherently different than saying, I don't have any money and I want to be a real estate investor, right? So we've got money on the sidelines. They're in reserves for things that could go wrong, but we're acquiring and rehabbing properties, utilizing other people's money. So let's not conflate these two. And most of the people that are buying courses, and most of the questions that I get about how to invest in real estate with no money down, it's not from the people that are saying, hey, I want to keep my own money in the bank and utilize other people's money to invest in real estate. It's people saying, hey, I don't have a job right now. I don't have any money. I'm looking to invest. How can I do it? And if you're in the latter category, if you want to be a real estate investor, but for whatever reason, you do not have any funds, the most important thing that I would do and where I would start is taking a really unbiased, use a lot of your, self-awareness, self-assessment to figure out the true reason as to why you do not have any money and correct that, right? So you're going to need to fix any of the holes you have in your personal financial bucket. Why have you been, spending more money than you have been bringing in? Fix those things. Start working on yourself, figuring out how to increase your income. Try to figure out how to bring more value to the marketplace. Figure out things that you can do in order to, generate some capital or liquidity events. Learning about real estate could easily be that thing. If you learn how to find deals, what I mentioned earlier, the 7 streams of deal flow, one of the most difficult places to be in real estate. So if you have the ability to generate a lot of deals, more deals than you could personally tackle, then you can start selling these deals to other people. That would in turn be you bringing more value to the marketplace and getting compensated for that. And as you are doing that, you're going to be able to start saving some money and start putting yourself in the category of, now you've got money in the bank and you're looking to use other people's money to be out there acquiring and renovating these properties. So working on yourself, fixing your personal financial situation, learning additional skills, and building yourself into the type of person that both banks would love to lend to and friends and family would love to invest in you and lend you some money so that you can go out and make some more money for them and some more money for you. I want to start investing with 4 single-family rentals in the $40,000 to $50,000 range with seasoning. Can I go to 8 homes in 6 months realistically? Well, so every bank is going to be different from a seasoning perspective, right? So we've talked about this a couple of times. If you're talking to banks that are going to resell their loans to Fannie Freddie after they originate them on your behalf, then all the rules are going to be the same. The seasoning requirements are going to be about the same, and you're going to be put in this really cookie cutter type format. If you find a local credit union that you've been a part of for a long time, they have a history with you, They know your finances. They are supporting you. They're going to keep these loans in their portfolio. Then I would say you're probably in a good position to hit this pretty quickly. Now, if you're looking to get to 8 homes in 6 months, then I would make sure that on the front end you walk into 10, 15 different banks that are local or regional size that would give you an audience with like their VP of commercial lending or something like that, and formulate a plan. Figure out what it would take for them to be on board, and start working that plan. If you've got the funds to buy 4 of these up front in cash, then the chances of you 6 months down the road pulling all of your capital back out with a bank that's already sold on your vision and already experienced in working with other investors in this way, then I would say the probability of this is very high. So I would say if I were you, if I set the goal of 8 properties in 6 months, which we could argue the how arbitrary that goal and how important that goal is, right? So, I would say building the fundamentals and the skill sets needed to do this is probably more important than the scoreboard on your property count at the end of 6 months. I would say handling 2 or 3 rental properties really, really well inside of 6 months would be just as big of a win as getting to 8 properties inside of 6 months. But if I were you and I were setting out to do this, um, my game plan would be finding some banks that are willing to kind of give you an audience, teach you the ropes of traditional finance, of what their bank in particular wants to see in a deal in order for them to be most comfortable lending on it. And I'll get 2 or 3 banks that give you their criteria, that tell you exactly what they love lending on. And then I would go out to the marketplace and I would look for these properties that fit their criteria, especially on this timeline that you're working with. I would confirm their seasoning requirements. I would make sure that they're down to have 0 to 6 months seasoning. And then this entire time, any of the cash that you have on hand, I would be looking to deploy that. I would say keep some reserves. And at this point, I would base the reserves on the individual properties. So I wouldn't necessarily want to throw out a blanket of $10,000 per property. I would say something to the extent of, for each of these properties that you analyze, make sure that you're looking at the 2 biggest capital expenditure items that they may face in the next couple of years. So if the roof is towards the end of its usable life, I would go ahead and figure out how much that roof is going to cost to replace. If it's $8,000, I would make sure that you have $8,000 plus the next capital expenditure item. So if it's the HVAC system, and that's going to be $4,000, then I would make sure that you had $12,000 specifically for that property. So that might be a little bit of an overkill once you start getting towards that 8 property mark. But since you're working on such a tight time frame, I would increase the kind of capital requirements in order to get started. So, and how much money you're keeping in reserves. And then the entire time that you're doing this, I would make sure that you are talking about this to every single person that you come across. I would start posting it on all of your social media. I would start kind of documenting your journey, and I would really start showcasing, what you're doing, why you're doing it, and be very vocal about it. If you are analyzing your properties and you see that the properties that you're buying, the amount of money that you need to put into them, the kind of holding costs that you have, how much it's going to cost to repair, do a full analysis on this, and figure out the highest amount of interest that you can pay and still adhere to your plan. And I would then start, as you are, documenting your journey, showcasing it to your friends, talking about it to every single person that you come across. I would start throwing in something to the effect of, hey, my goal is to get to 8 properties in 6 months and then get to 40 properties inside of 18 months. And I'm going to scale the business and it's going to look like this. And this entire time, while it's going to be profitable for me, I'm able to, borrow money from friends and family at, X%, whatever that number comes up to be in the deals that you are analyzing. And I would say, and those are going to be interest only payments paid out on a monthly basis. And they're going to be secured by, whatever you have to provide as collateral, whether it's the first property that you were able to pay for all by yourself, or whether it is, a second position mortgage on, your personal residence, or whatever it is that you have to provide as collateral that you think it would be a good deal for your investors. And I would say, if you have any aspirations to scale a real estate investing business, the most powerful thing that you could possibly do is build a network of private lenders. These private lenders, people that believe in you, specifically you, that are willing to take a chance on you, that trust you to always do the right thing to make them whole. I would come up with a scenario that may even be more advantageous to your investors than you at first, right? So if it is painful for you, if it makes you break even on your business, I wouldn't necessarily entertain going into the negatives in order to make this work, unless you are sitting on a significant amount of reserves and can weather it. And building up the trust of a couple of key people at first are more important than the income that you're bringing in. But I would definitely put like a hard end line if you're going to operate like that. Because the more private money that you're able to raise, the more individuals that you have willing to lend you money to help you build your future and your goal and meet your real estate investing goals, the better off you're going to be. They're going to be more agile. They're going to be more understanding. They're going to be more quick to lend to you than any traditional banking that you have. So since I just finished answering the question about that federal lien, I would say, make sure that you always kind of are able to polish yourself up, present yourself as a really solid choice from all the traditional banking metrics, the credit scores, the personal financial statements. Make sure you keep those really strong for when you need to transition or refinance into a traditional lender. But I would also say constantly be building that network that you have of private lenders. So we have, I've spoke about this previously. One of our first private lender was a good friend of mine that I went through the police academy with. We left the department at about the same time, and I had, read some books, mainly How to Raise Private Capital or Raising Private Capital by Matt Fairclough, a solid book to get yourself introduced to the idea of private lending, taking former retirement accounts and rolling them into self-directed options and then lending them out. If you can just educate yourself on that, and then it really just comes down to inside of your network being at the right place at the right time, learning of someone that's leaving their job and coming up with a nice, friendly, soft pitch of, hey, this is an option available to you if you did not want to leave your funds there, right? So after we got our first private lender that way, well, now we can say, we've got a little bit of kind of a track record working for us of working with private capital and, having an individual that has in fact lent us money and has seen that interest only payment hit their account on a monthly basis. Now they can vouch for us, and it solidifies us. It takes it from theory to a reality. And, not many people want to be the first. So because we went through the academy together, because there was a significantly high trust there, he was willing to do that. And, I kind of harped on that in each of the times that I've mentioned that from here on out. So as soon as we got that one, it's, hey, we regularly borrow money from friends and family at this interest rate. And then just briefly describe how it goes, right? It's interest only payments on a monthly basis secured by a first position mortgage on a property. So here's our buying criteria. And this is a really strong investment because in the event that we are unable to go through or unable to follow through, we default on our payments for, whatever reason. That's the last case scenario. We never want to do that. We're not striving for that. But in the event that happens, you get an asset that's worth more than your initial investment. So it's a very, very safe way to lend money. And now, since we've been doing this for 4 or 5 years now, we have private lenders that have been with us for a while, some friends and family that are referring other people in their network to lend to us. And, because we were prudent, because we diligently uh, worked in building those relationships and those pipelines, I mean, we've been able to raise a couple million at this point just based on the referrals of, raise is probably the wrong word. We have received several private loans from friends and family secured by first position mortgages in the tune of several millions, just based off performing for people, having happy lenders that are willing to tell their people about it. So it's definitely something that you should have a longer term vision of. But if you have any aspirations of building your portfolio past this initial 6 months to get to 8 properties, if you're looking 6 years out, then I would say one of the most important things that you can do is being very intentional and very vocal about your plans and raising private capital from people that want first position loans and mortgages on their properties. Is it possible to get into commercial multifamily, like a 25 plus unit investing with no experience and long-term hold and rent experience? Thank you. Is it even prudent to do so? If you have a significant amount of capital to start with, I would say yes. I'm not necessarily familiar with the commercial real estate loan. We do not own anything that is 25 units or more. So I'm not speaking, and I cannot speak from experience pretty much on anything related to this. We have a 4 unit. That's the biggest unit we have. We've got a couple of those. We don't necessarily like them. We're not out here trying to get more. And we're also not trying to get into 25 plus units ourselves. So I know the friends that I have, they're doing like the syndication, the really large units. They have a whole team of people that are behind them. And, Fannie Freddie, I think they do a lot of lending. There's a lot of government backed loans. There's whole programs based on this around apartments, a lot of non recourse happening, but they have their minimum experience requirements in order to get those loans. And a lot of the syndicators with no experience are able to get these loans by including people in on the deal that do have previous year's experience. So I would say if you're looking to get into that space, maybe your first deal or two, don't do it solo. Try to get part of or be part of some type of syndicate. Try to be a little bit of a hands-on role there. And then the first syndicate or two that you're a part of, you might take a smaller role in it, but you're then able to use your involvement in that syndicate as experience whenever you want to go out on your own and get one of these commercial properties. So I've already said it once in this call, maybe twice, but there are just as many different ways to make money investing in real estate as there are people investing in real estate. Each type of real estate investing comes with its own set of pros and cons. So I think more so, ROI being the same throughout. Sometimes that's true, sometimes that's not. It really comes down to a personal choice, and it really comes down to what type of problems you want to deal with and what type of problems you don't. For the type of business that I am in, for the type of real estate that I'm investing in, there are the pros and cons of having a portfolio of single family homes are far more appealing to me than the pros and cons of owning multifamily properties. So because of that, we are going to continue building out our single family home portfolio. But I've got many friends that are really big into the multifamily space and are doing a really solid job. So I'm sure investing in this manner is prudent, and I'm sure it is advisable if you speak to the right people and if you surround yourself with the appropriate network. So rather than kind of jumping in kind of by yourself, I would say that you should work really hard to build a network of people that already have the type of portfolio that you are looking to build. Become good friends with these people, and try to win them over as mentors and people that you can call as you have questions and are concerns as you are building this. I would say one of the things that Will and I did really well is from the very beginning, we surrounded ourselves with people that already had portfolios of 30, 40, several hundred properties, right? So that's not something that we came to the market with. We intentionally built that so that each time we came to a crossroads where we didn't know what to do, which as we first started was very frequent, sometimes daily, we had a network of people that we could call and help us make those decisions. And I would say in doing that, we circumvented decades of trial and error and probably, millions of dollars worth of potential mistakes that we could have made if we didn't seek the counsel of wiser people. So emphasis on that. Thank you. I appreciate you guys being on here. 13 people. I'm super pumped. I would like to stay for a significantly longer time. However, we're closing on 6 properties, and those start at 9:30. So I need to get to skedaddling. I really appreciate all of you. Let's see here. Things I can ask of you to do if you appreciate this channel is watch the videos that we're putting out. Some weird things have happened, and I'm sure after talking to a couple of people that I'm really close with that are, supporters of this channel, this type of sit down content, live stream question and answer, it's got a place. It's really good, but the views are dwindling. So, a couple months ago, probably at the beginning of the year, we were getting about 2,000 views per video. That has dropped to lesser than 100. I fully understand that if I were to start going around to these properties, if I were to start making videos that are a little bit out and about, maybe a little bit more entertaining, those views could pick up. But nonetheless, right now, where I'm at, this is what I have to offer for this channel. So sharing these videos, if you find them important, if you see some of the videos that come out throughout the week, please share those. And if you have anybody in your network that's even mildly interested in investing in real estate, feel free and please share this channel with them. And know that we are slowly working on providing some really awesome content and working some good YouTube strategies to get this message out to all the right people. However, I am extraordinarily thankful for all the subscribers that we already have. I have made some fantastic relationships with people from this channel, and I really appreciate each of you. If you have the mildest inclination to reach out, please do. There are, let's see here, one of the guys I'm most thankful for that I've met from this channel actually works with us on the property management side now. He's been able he moved here. So 2 people from this YouTube channel that I've been able to meet from this YouTube channel have moved to the Dayton area to start helping out in restoring this community, which is super cool. I'm absolutely honored to know them and super proud of all the work that they have already been able to do. One of them has built a portfolio of about 12 or 13 properties so far. That's after a little bit of over a year being here. And another guy just moved here a couple months ago and is already working on on acquiring his 3rd property. So they're fantastic people. There's tons of opportunity here in the Dayton area, and that's I'm super thankful for YouTube being the catalyst to forming a lot of really solid relationships. And even though this channel doesn't pull in the views, it definitely, when people find the channel, when they dig in, when they have questions, show up to this live stream, email, some questions, relationships are built, and it is really, I'm super thankful for it. Even some private lenders have have come out of this YouTube channel, and super thankful for that as well. So I appreciate all of you. Please like the videos as they come out, share them with your friends as you have the opportunity to do so, and as that comes up in conversation. And if you have any inclination to join the mastermind group, then that is also available. Let me go ahead and put that, seek-wisdom.com/join. And there are currently 2 groups. It is, $300 per month, but I think I'm biased, of course, but I think that is a very small price to pay for the network that opens up. So I appreciate you all, and I will talk to you all soon. I'm going to go buy some properties, and I suggest that if you have properties already, then dive in deep, figure out in what ways you can build your network, and what ways can you start bringing in more leads, both for your own portfolio and to share with other people. And if you do not have any properties yet, then I would highly encourage you to start reading everything you can, start figuring out where people that already have portfolios hang out, and start hanging out and building all of your friends around real estate investing. And hey, anytime that you have the opportunity to mention real estate investing, bring it up in conversation. And all of the people that have negative things to say, figure out why they're saying them, and kind of help walk them through, if you had that same problem, what ways could you have fixed it without going, under or selling their properties or whatever they did as a result. And I think you'll be, well on your way. And with that, I will talk to you guys soon. Next week, Friday morning, 8 a.m. Eastern Standard, I will be right here, hopefully. My wife's due date was this past Monday, and there is still no baby. So no idea when this baby will show up, but hopefully it is not next Friday at 7:30 a.m. Eastern Standard Time. So long as that doesn't happen, I'll be right here, and I will talk to you guys then. See you then.